One of the most popular stock YouTubers, Jeremy from Financial Education, has lost over $1 million from just one stock. And not only has he lost subscribers from this, but many people are now asking themselves if they can trust not just Jeremy, but all of the financial content creators. And so in this video, I want to share my thoughts about this whole tattooed chef situation and where I believe financial YouTubers are going to be moving over the next few years. But I don't want to waste your time, so let's go ahead and dive right in. So the Financial Education channel has been around for a long time, but we didn't really see a major spike in subscribers until really 2020. Jeremy currently has over 700,000 subscribers, but he has lost a few thousand over the past few months after several of his stocks have not performed well, including Voyager and Tattooed Chef. But the one stock that Jeremy is most known for is Tattooed Chef, which he announced he has lost over $1 million. And unfortunately, many other people lost money in this one as well. So what actually happened and how does this affect Jeremy's reputation? Tattooed Chef was a stock that Jeremy started buying around the beginning of 2021 when it was over $20 a share. And over time, this became the stock that he was most known for. Now, Jeremy has had some great stocks in the past. And before the chef, he was most known for his best performer, which was Tesla. He even made several videos talking about how TTCF was going to be his next Tesla, which basically meant his next stock that was going to 10x his money. But the issue is that because he was so successful with several of his companies like Elf Beauty, Revolve, and Cirrus Logic, many people thought that they could trust him with the Tattooed Chef investment. And so those people put in their own money as well. But this was one I talked about on my channel back in February of this year, warning people that their revenues were not correlating to the expansion in SKUs and their margins could continue to struggle throughout the year. And even though I don't like talking bad about the company, the truth is that what I said came to fruition. Even Jeremy posted a video recently showing his frustrations with the management team's execution. And here's what the company reported during their Q3 earnings call on November 15th. Revenue actually declined 6.7% year over year from 58 million to 54.1 million. And so as a growth company who is expected to grow 20% annually, this is awful. The next metric is incredibly important, which is their gross margins. And this was actually negative at 7.2% compared to a gross margin last year of positive 8.6%. Now, the worst part about these numbers was that freight costs actually peaked in the third quarter last year. So for the chef to perform even worse with lighter conditions goes to show that there is something wrong with their business model. And to make matters worse, their operating expenses more than doubled, going from 12.8 million to 31.6 million this year. This was a massive move for a company that is only expected to grow 20% this year, and even that could be debated. They also reported adjusted EBITDA loss of $25.5 million compared to a loss of $5.1 million last year. So the company seems to be moving away from profitability, which in this kind of environment, nobody is going to want to invest in a company who is losing significant amounts of money. On top of all of this, the company now only has a cash position of $14.2 million with $20 million drawn from their line of credit. Needless to say, this company did not perform well at all this quarter. And lastly, when we look at their full year 2022 outlook, it is horrific as well. The company brought down their revenue guidance from between 280 million and 285 million to now in the range of 235 and 245 million dollars. That is a 15% decline in their guidance for the year from the midpoint. And after the earnings release, analysts have the company generating 258 million dollars in revenue. And I wouldn't doubt seeing this number fall even further. Next, their expected gross margins also declined from 8 to 10% to now between 0 to 3%. And this is what I believe frustrated Jeremy the most, because he talks about how does selling a frozen meal for $5 not become profitable over time. And to just add the cherry on top, the company intends to raise additional debt or equity capital in the near future. So in other words, they're expecting to accumulate more debt or even dilute shareholders at a point in time when the company is at all-time lows. So the company is probably in the worst position it has ever been. In this current economy, the kinds of rates Tattooed Chef will get are not going to be good. And if they were to dilute shareholders, that would mean that they need to add a lot of shares in comparison to if they diluted the company when it was $12 a share. However, despite this horrendous quarter and honestly year, Jeremy is continuing to hold his shares because he hopes that the margins will improve over the next year. But here's the thing. I don't believe that the issue is Jeremy investing into TTCF. I think the even bigger issue is the fact that this was his #1 position. And when your top company is not performing well both in share price but also as a business, people are going to question if they should listen to you. Jeremy knew that the chef should not have been his #1 play, and he even made a video explaining how he needs someone to keep him accountable so a situation like this doesn't happen again. But unfortunately, there's no going back. And let me say that situations like this are not only bad for viewers on YouTube, but it also hurts the entire financial content creator community. What we have seen over this past year is how much of a role content creators play in a viewer's investments. And this has not only proven itself in stocks, but also sponsorships. FTX, for example, which is a crypto brokerage, has just filed for bankruptcy, and many YouTubers, including Jeremy, were promoting them. So this whole situation has made it difficult for viewers to actually trust investors who are content creators. So who's really to blame in this whole situation? And what should financial YouTubers do now? I think that there are two different ways to look at this. On one hand, content creators should understand and recognize how much their perspective is actually worth in the eyes of a viewer. So when we share the stocks that we are buying, I believe that the risk needs to be talked about just as much as the reward. And I hope that for any of you that have watched my channel, you feel like I've done a pretty good job addressing both. But if not, please let me know in the comments down below. I firmly believe that companies who are unprofitable should never be the majority of your portfolio. And even for the year 2022, I shared that the companies investors will want to stick with are those who are either going to be profitable in the next year or are already profitable, which is a major reason why my largest holdings are in stocks like Palantir, CarParts.com, and Shopify, which have already proven that they can be profitable. But that doesn't mean I don't own speculative plays. I still own companies like Shift and Opendoor, but in comparison to my overall portfolio, they make up less than 10%. But with all that said, on the other hand, I also believe that anyone who watches finance channels, especially stocks or crypto, needs to understand what they are invested into. I know from experience that it is easy to just buy a company or crypto based on the fact that people have talked about it and that there is huge potential. When emotions got in the way of my investing strategy, I lost money every single time. And if I'm honest, I think that this is what happened to Jeremy and his tattooed chef position. Because even now, he says that he hopes that the company will produce better margins. If I'm an investor, I would not want my investments, especially my number one position, to be built off of hope. After seeing freight costs significantly off their all-time highs, their small cash position, and a high likelihood of needing to raise capital or debt, it leaves me to question what they're going to do differently in the short term that could help them have better margins for 2023. Now, I want to mention that this doesn't mean I don't believe in Jeremy or his investing strategies. Him and I actually share similar positions in Palantir and Honest, so I do believe in some of his companies. But after everything that has happened with Tattooed Chef, several other stocks that people have promoted, and FTX, the finance channels are going to need to be way more cautious in terms of the stocks and sponsorships that they promote, and that includes myself. We need to talk about what are the risks for the companies we invest in, and maybe even share what percentage of our portfolio these positions will become. This protects us as the content creators, but it also protects viewers, especially beginners who have just started investing over the past couple of years. And those are my thoughts. Hope you all enjoyed this video, and I'll see you in the next one.